Hey, what's up guys? So today I wanted to talk to you about a simple index fund investing strategy that can make you a tax-free millionaire by the time you're 50, or at any point in time can make you a tax-free millionaire in maximum 30 years. So we're told when we're young, at school you get told of millionaires and billionaires and you see loads of stuff on social media and you think that that is some really far away dream that's really difficult to achieve, and it must be, only the elite of the elite, the superstars of the world that get to that level. But actually, if you break it down into simple financial terms, there's a relatively robust way that you could become a millionaire by the time you turn 50 or in 30 years, depending on when you start the investment. And all it takes is £460 a month invested into a fund and left there passively over the course of 30 years. So obviously this relies on some assumptions. So one of the first assumptions is the stock market will continue to grow at the same rate that it has done for the last 30 years. Now, in a capitalist society that we live in today, that's quite a high likelihood situation, because even with things like coronavirus, they're short-term blips and downturns in the market. But in the long run, we're always looking to improve economic growth and improve GDP. And so it's likely that the growth of the economy will match the average growth of the market over the last 30 years. Another assumption is, of course, that you have £460 a month to invest over the course of 30 years that you can just leave in this fund and allow it to cumulatively gain interest. Now, of course, that's quite a difficult thing to plan ahead for because obviously there are uncertainties in life. But the way that this can be accounted for is also, if you don't have £460 a month now to put in, you can put in a much smaller amount now and increase the amount that you're putting in per month as your salary increases and as you progress through life. So that's kind of the basic assumptions of this. So what you would do is you would open a index fund, which for me personally I'd recommend the Vanguard S&P 500 ETF fund with a 0.07% charge and an average of 7.53% return per year over the last 30 years. Hey, what's up guys? So I just wanted to let you know, whilst I'm editing this, that I thought it wasn't entirely clear exactly what fund I was on about and exactly how to get involved. So I thought I'd show you because that's the best way to do it. So my screen should appear on the video now. And so here, basically, this is the index fund that I'm talking about. So this is the Vanguard index fund. They offer loads of different funds, but essentially what they've got on here is a full list of funds, and you can find the S&P 500 UCITS ETF fund. So this is the fund I'm on about in the video. It has a 0.07% ongoing charge. It doesn't have an opening or a closing charge, and it's essentially just a really good index fund to be involved in. You can go on here yourself and follow the link. I'll put that down in the description, but that will give you all the different kind of breakdowns of how this fund works. One thing to look at, of course, is the past performance of the fund, and then going down a bit further you can look at the past performance based on a lump sum. And in the video I also realised that I mentioned this 7.5% as the 30-year average of the S&P 500 index. Now, of course, that's a good long-term average to take, but if you look at a kind of a shorter term or longer term breakdown, depending on how quickly you're looking to get your rewards, then that average can actually change quite drastically. So if we look at the 10-year average, the 10-year average is actually 15.3%. So if you invested 10 years ago, you'd be much further ahead than the 7% figure that I gave would recommend. However, if you're looking at the 20-year average, that's down at 5.9%, so it's actually slightly below the tracking of the 7.5 that I said. But I just thought I'd point those two things out to you to make it clear exactly which fund you should be looking at, and then also to have a look at the fact that the rate does change depending on how long you're invested, and that 30-year 7.5% I suggested was just a recommendation of a good long-term average to take for the S&P 500 index. Alright, back to the rest of the video. So then what you do is you direct debit £460 a month into this index fund as soon as you get your paycheck, so you're not tempted to spend it on anything else. And you'd reinvest all the dividends that get paid from this fund, which average about 2% dividend yield per year. So if you can do that, then all you do is you leave that running in the background, and that's essentially your retirement fund at this point. And over the course of 30 years, that should, if the average is true, stick to around about just over £1 million tax-free by the end. Now the reason it's tax-free is that you can set up this index fund as an ISA, and because you're paying in only £460 a month, that pays in at less than the £20,000 maximum a year that you could pay into this ISA. And so you don't get taxed on any of the interest earned in the account, and you don't get taxed when you make withdrawals from the account. So that £460 a month as a flat rate for 30 years may be slightly unrealistic, because obviously at the start of your career you may not have £460 a month that you can spare, and towards the end of your career you may have more than £460 a month that you can invest. And the way you can kind of scale that is just by changing the amount of money that you put in based on how much you have at each point. And what you can do is then you can put in your own numbers and figure out, say I could only put in £200 a month now, how much would I need to increase that by each year to mean that I can end up with £1 million tax-free at the end? Now, of course, remember you've got to keep a cap on that, so you can't put more than £20,000 a year tax-free into an ISA. Any amount over that then starts getting taxed when you take the money out. And another benefit that you can have is that if you can actually put more than £460 in a month, then obviously that will shorten the amount of time it takes to become a millionaire tax-free. So if you can put an extra £100 in a month, then that normally takes around about 3 years off. And it's not quite a linear scale, but that takes out approximately 3 years. So if you put £560 in a month rather than £460, then it will take you only 27 years to reach that million mark. And another great thing that you can do to help is putting in lump sums. So say at any point in time, whether it's through the unfortunate situation of somebody near to you dying and leaving you some money, or whether you do a job that gets a large payment in one go. If you put lump sums in, if you can put £10,000 in the first 2 years of this investment, then what that actually does is that takes 5 years off the amount of time that it takes you to become a millionaire. So then the question is, well, what do you do once you have £1 million in the bank? Well, you can use that 1 million essentially to retire if you want to, because $1 million is enough money to retire using the 4% rule, which I'll do a detailed video on in future. But the 4% rule essentially means that if you've got $1 million and your investments are growing by the average of 7.5% per year, you can take 4% of that out every year and use that to live off. Now that gives you around about £40,000 a year to play with without having to do any other work. So if you can reach that in the 30 years and you start this fund at 20, then that means that at 50 you might have enough money to retire already, which will put you 15 years ahead of the national average retirement age of 65. So as much as we're sold that being a millionaire is some long shot dream that you have to start your own business, or you have to be a very successful entrepreneur, or be in a very high-end career to achieve, actually your most useful accolade to get towards becoming a millionaire is time. The more time you have, the less money you have to put in, because the more work cumulative interest can do for you. And that's the whole way that this principle works, is that it uses cumulative interest to build your wealth over time. So using that cumulative interest in your favour means that the longer you have, the less money you have to put in at each individual time step in order to achieve that final goal. So that's one thing that's really important, is the younger you are and the earlier you can get started, the more of a head start you have over other people. So that's a very quick, brief explanation of how you can become a tax-free millionaire in 30 years using a Vanguard ISA index fund. If you have any more detailed questions, let me know down in the comments. If you like the video, then hit the like button and maybe consider subscribing if you're new around here. And if you do want to do some investing that isn't through this index fund and you want to do your own picking of stocks, then maybe I suggest setting up a Trading 212 account using the referral code down below, and that will get you a free stock to start off with worth up to £100. And that's everything for this video, and as always, thank you for watching, and I'll see you in the next one.